Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. Look around and you will see the same patterns emerging. Interest rates are going up, inflation is going up, supply chain problems. But what if this was about to flip? We will talk about the economy today. We're going to talk about China today. And I want to look at what's happening in the markets as well. I got a lot to cover. So let's begin by taking a look at this. Global leaders warn of economic dangers as crises multiply. You look around and see these things piling up one after the other after the other. The first thing I want to highlight here is what's happening in China. Shanghai district to require all shops to shut, residents to stay home. This is continuing. I warned about this over and over again that if we start to see it, we would have a repeat of what's going on in 2020. Some aspects have started to reverse, but clearly that isn't over yet. So you could look here, this key commercial area of the Chinese financial hub said it's going to require all supermarkets and shops to shut, residents stay home until at least Tuesday. So I will give you updates on that as it happens. Okay, they're given exit permits and so on. So this is a very strict lockdown. China's zero policy is an anchor on commodity prices. So we're seeing the same kind of thing. And, you look, actually, I can show you this right here first. Beijing sees most cases this outbreak, lockdown, and angst renews. So Beijing is dealing with the same kind of thing. So you got Shanghai, you got Beijing, they're, encountering this situation, and nobody wants to see that. The economy doesn't want to see that. The markets don't want to see this. Lockdowns mean slower growth, less consumption, and ultimately prices of stocks will be concerned about it. At the time of this recording, there's been a lot of talk about getting the markets in China boosted up. Why? Well, we'll look at it further, but I just want to highlight the fact that right now there has been, this is Shanghai's exchange. You could see what's been happening over the last several months. The prices have gone further and further down, but now China is starting to really stimulate. Unlike the rest of the governments around the world, there's, basically going the opposite direction. Okay. So this is basically just saying that the cases are rising and so on in Beijing. And of course, they might do a lockdown and so on. That's key. It's key to watch, and I'll bring you those updates. Okay. So back to this article here is just showing us that when we have these lockdowns, when we have concerns, less consumption and so on, then commodities could really take a hit. Okay, if you've watched this far into the video, I've got a bunch of things written down that I really wanted to get to and why this is all very important. I'm going to break that down further in just a couple minutes, but I want to cover the China thing because that's going to tell us, that's going to be our bellwether. That's the canary in the coal mine. So watch this closely, okay? China's dependence on foreign soybeans is an inflation worry. Boost from government stimulus may not show up until 2023. So the government's doing a few things, but like it always takes time to take effect. Industrial commodity prices in China have regained some of their poise after Shanghai issued a roadmap for opening up and central bank cut interest rates on long-term loans. So that's important to note. You want to see stimulus, like if you're looking at stocks, if you're interested in what's happening with the economy, you want to see stimulus. You want to see reduced interest rates. You want to see opening up. You want to see opening up in terms of like lockdowns and the economy in general. But you want to see general opening up where people are going out, they're going to the shops, they're going to the restaurants, they're spending their money, they're getting together, there are gatherings, all these things happen, and that gives confidence to the consumer and to the businesses as well. The monetary easing on Friday looks to have been aimed at the embattled housing market in particular, which would be helpful to metals demand. If you got to build houses, you got to have all that stuff, okay? And it's apartment buildings, they're going to need concrete, they're going to need steel, they're going to need copper. Iron ore is a big one, okay? Watch that. And Australia, my friends, take a look at what happens with your exports, okay? Big time. Australia and China, they've been battling it out for the last little while, so watch very carefully and closely. Okay. It's still difficult for stimulus to gain much traction if large swaths of the economy, including now Beijing are threatened by the kind of disruptions that have engulfed Shanghai for 2 months and counting. This is why the stocks have stayed down considerably for Shanghai. They didn't bounce up at all for the most part because there's worry about lockdowns, what's going to happen, and so on. Is this 2020 again? And here we go. China banks cut key rate by record to boost ailing economy. This is a record, although it's still, reasonable, but that's a record cut. Why? Because they need to get this thing jacked up. Mortgage lending and home sales both fell last month. Regardless of what people say, you have a company like Evergrande which collapsed. You look at the stock, you'll find something interesting for those who say it didn't collapse. Let's look right now. Take a look. Hey, it's not bad, right? Well, what's that trading day there? It's March 18th. Wait a second, we're in May. That's right. They halted the stock. And why did they halt the stock? Well, different reasons, but what's happening right now is that they simply said, okay, that's enough. You're done. We are now going to force other companies to buy you up. The company was gone. It's a forced fire sale on these different pieces of Evergrande. That's basically what's happening. That's an oversimplification of it, but that's what's going on. Now, let's get into the next aspect, which I think is real key. Let's break it down. I'm going to show you all this. I'll give you all the details, give you all the articles, everything. Just stick with me for 1 second. Massive levels of inventory have been built up at this point because all these companies buy. They don't necessarily need it all, but they've been buying a lot. Anticipation of higher prices and longer shipping times is the reason for this. Recession risk likely reduces demand. If they believe by 2023 we're in a recession, well then, are they going to really need to buy all that stuff? Some stuff, but maybe not all of it. Companies are suggesting right now, believe it or not, that they have too many workers. We went from having a shortage to some companies saying, we've got people just standing around doing nothing. Mass layoffs could be next. You got it all? Okay, that's the overarching theme. That's what it's all about. It took me, 8 minutes to get into that all, but I wanted to really highlight that for you today. So let's get into the next aspect here as we look at what's happening with companies like Walmart and Amazon. Interesting stuff. Walmart and Amazon aren't seeing a labor shortage. They've had too many workers, and now it's taking a financial toll. I don't think it mentions it in this article here, but Amazon is going to sublet or give away, in some cases, I think it said, something like 10 million square feet of real estate. That is a complete departure from what happened, all from 2020 up until now. Strange. I want to look into that more, but we'll see. Walmart said it was overstaffed during the most recent quarter, denting profits. Amazon faced the same overstaffing issues in its warehouses during the first quarter. It's a unique problem for two of the nation's largest employers after months of US labor shortage. Think about what we're saying here. Walmart, Amazon, massive companies. This isn't, your corner stores. These are huge companies that employ a lot of people, and they're saying we have too many people now. We were going crazy. We were trying to get more people. Now suddenly we don't need it anymore. Do you think perhaps this has to do with their stock as well? How do we increase our productivity? We fire people. That's the way it goes. All right. Walmart hired extra associates at the end of 2021, but people came back to work sooner than expected. Now it's time to kick them to the curb. That's basically what they're saying. Several weeks of overstaffing at the retail giant meant several weeks of wage pressure, which ate into the profits for the quarter. Profit declined 25% from last year. Big time, all right? Amazon couldn't hire workers quickly enough until last quarter. Things changed, didn't they? Okay, so they talk more about this. It's interesting, really interesting. Amazon was hiring hundreds of thousands of people. 2020, everybody's firing. And then this time it comes around, and now Amazon is getting rid of people. Wow. Very unique circumstances. Connecting in with this. Bloated inventories hit Walmart, Target, and other retailers' profits, trucking demand as well. Too much stock means lower truckload volumes, more intermodal business. So there's a lot in here. I don't want to, um, you know, get into too much of the nonsense that really won't pertain to you. But that's what you need to know. Okay, there's little in retailing that Walmart and Target aren't prepared to handle. So it was jarring that over a 24-hour period, the two scions of the trade posted weak first quarter profits that appear to blindside their management teams. So these are huge. Target, Walmart, Amazon, all feeling this right now. Bottom line blow up was due to fuel. Record high prices. You're seeing that right now. Margin pressures. Of course, prices of everything have gone up. Then how much can they push onto their consumer? How much can they do? Well, they try to increase their prices, but if the consumer's not going to bite, it's not going to do them any good if they aren't, selling. Okay. Overshoot of inventory stocking activity, which came back to bite the retailers. That's right. Buying too much of that inventory. I told you many times that what these companies were doing, the reason there was so much demand and part of the supply chain problems was they were pulling that demand from the future into the present. I discussed this so many times. They pulled that into the present. So it looks like the economy is so healthy. Look at the demand. Wow. But really, they were taking next year and pulling it to the present. You see what's happening here? You do that, okay, it pushes it up temporarily. But what happens? Well, they're calling this the bullwhip effect. And only time will tell, but I think it's a concern. And of course, for some stuff, there's still going to be a demand, like food. But for some things, I mean, how many flat screen TVs are needed? This is showing us inflation looking at around, the US and the UK, both quite high historically. But even other places like Japan, can you believe it? They're expected to actually see a little bit of inflation. My goodness, my goodness. You see what's going on with the markets. It's just showing us the current, like the size of the S&P 500, 10% plus corrections. And just take a look. This is the current one. You could see that. Recession median. It's not even there. If this is a recession, still got more to fall. But historically, it's quite high. Non-recession median is 12.5. So we will see, is this a recession or not? I can tell you along the way, there's a lot of bear market rallies that happen. This is 2008 into 2009. And I want to highlight some of this. Look at some of these bear market rallies along the greater trend. 11.5%, 18.5%, 19, 8, 8, and 23. But the trend, still actually probably like this for you, the trend down. So there's ways to make money all the way down. And as you get these bounces, some people see it as a buying opportunity, but for some people, they're not going to be able to get out of that. I thought it was interesting. Wanted to bring this to you real quick. Value of global exported goods as a share of the GDP. So back in the early 1900s, they say right here, first local peak in globalization. But then after the 1940s, things changed. And now, really since, 2000 and, financial crisis, basically, the second local peak in globalization. Is something changing today? Or this potentially reverses and we go in the opposite direction? Or are we going to see the walls closing in? Are we going to see bigger concerns? We're going to see a global economic collapse and everything changes. I don't know. Only, with inflation, it's going to be our biggest indicator because that's going to determine interest rates, and interest rates are the big one to watch along with the Federal Reserve's balance sheets. I think it's real key to understand those two things. Those are the things I pay attention to more than anything else. So here in this video, I brought you what you need to know related to the bullwhip effect, to what's happening in China, to inflation, as I said, interest rates, and the economy in general. If you see the markets right now, today, you might be thinking to yourself, what's going to happen? Well, it's so hard to tell, but you've got to see how much of what we are looking at is already priced in. A recession isn't priced in. But we do know that the supply chains and everything, yeah, that's all there. Higher levels of interest rates. By July, remember, keep this in mind. I'll leave you with this. By July, the potential that the Fed funds rate is at 2% is like that's the baseline. Fed funds rate at 2% in July, just a couple months away. And that, of course, is much more tight than what we had seen just a few months ago. So keep that in perspective. I hope you appreciate this information. Hit that thumbs up button, and I'll see you on the next one. Take care.